The US Fed spurs Wall Street, leaves rates unchanged and shifts the dot plot to project one rate cut this year. Chairman Jerome Powell also rules out hikes and seeks more confidence and data on inflation before a cut. CPI inflation for May comes in lower than expected at 3.3%. Asian markets rise following a strong handover from Wall Street. The gift Nifty is also suggesting a higher start for the Indian market. Crude prices pair gains on an unexpected rise in US inventory, with Brent hovering around that $82 a barrel mark. Gold prices too remain range-bound after the Fed says it expects to cut rates only once this year. India's retail inflation eases to 4.75% in the month of May. Core inflation cools to 3.1% even as food prices remain stubborn. Industrial output in April remains steady with a 5% growth rate. Around 40 Indians have lost their lives and over 50 are injured in a blaze at a labor housing facility in Kuwait. 2 Indians recruited by the Russian army have also lost their lives in the conflict with Ukraine. The Indian government takes up the matter strongly with Russia and calls for the early release of all Indian nationals in Russian army. Good morning in the Mumbai News Center. I'm Sonal Bhutra. You're watching Power Breakfast. Those are the top headlines, and the biggest one, of course, coming in with US Fed not changing the rates and talking about just one rate cut this year. Before we discuss that in greater detail, let's take a look at the Asian markets. They're higher after this particular decision, most of them in the green right now. If we look at something like a Taiwanese index, it continues its up move. It's up 379 points. Hang Seng, after those 3 days of losses, has come back in the green. It's up 201 points. We do have something like a Straits Times as well, which is trading in the green. Nikkei is higher. It is flat but with some positive bias. So it's a green looking screen as far as the Asian markets are concerned. The gift Nifty too is indicating a higher start for our own markets, 91 points higher. Remember, we did see that record high yesterday. We came off from those highs, but today again looks like there could be a good day on the Lal Street for the bulls. Moving on, the US market, and let's talk about that. Wall Street ended Wednesday's trading session mixed. The Dow closed 35 points lower, while the S&P gained 45 points and jumped to a record closing above 5,400 for the first time. The tech-heavy index, the Nasdaq, finished nearly 265 points higher. Inflation rate in May slowed to 3.3%, which is below 3.4% in April and forecast of 3.4%. Meanwhile, in stock-specific news, shares of Apple climbed after the company earlier unveiled its artificial intelligence plans called the Apple Intelligence. The iPhone maker briefly surpassed Microsoft in market value as well. And the big cue from Wall Street was the Federal Reserve's interest rate decision. The central bank decided to keep interest rates steady at the current range of 5.25 to 5.5%, but revised the outlook for rate cuts to just one in 2024. CNBC's Steve Leisman has a roundup of the data.
It was a dovish morning followed by what you might call a hawkish afternoon for markets. And you can see the entire drama playing out in bold relief in the bond market, where yields plunged on the 2-year note with that better than expected inflation report this morning. Then they bounced higher with a more hawkish Fed statement and projections than the market had expected. Though bonds did hold on to some of their gains, and stocks seemed to, well, ignore at least a good part of the what the Fed did today. Forecasts for the Fed this year for the funds rate went from 3 in March down to 1 right now for the full year. They did raise the neutral rate, suggesting they think they're less restrictive than they were before. They see higher inflation this year and a modest nod in the statement to the recent inflation progress that we've seen. Fed Chair Powell was maybe a bit more dovish than the statement and the projections. He suggested 1 or 2 cuts were still possible beginning in September and that he welcomed today's inflation report. But he suggested Fed officials remain cautious because of that spike in inflation we had in the first quarter.
What we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that. But so far, they haven't had to. And, that's why we're watching so carefully for signs of weakness.
The September Fed Funds Futures tells the story, too. Exuberance about rate cuts after the inflation report lifted that probability 73% from 55 before CPI. Traders then dialed back their enthusiasm and bid it down to 61% after the Fed meeting. I think you can think of the difference between the Fed and the markets as one between optimists and pessimists about inflation. The Fed, maybe a bit like the groundhog that saw its shadow in the winter and crawled back into their hole, declared 6 more months of high inflation. The market, they've seen the sun break out from behind the clouds during the last two inflation reports, and they're ready for summer, the beach, and rate cuts when they come back in September.
Okay, Fed leaves interest rates unchanged. In fact, the Fed Chair Jerome Powell also spoke about how they needed more good data on inflation in order to have the confidence to cut rates and have no hikes on the table.
The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. And we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, you know, since we raised rates this far, we've always been pointing to cuts at a certain point. Not to eliminate the possibility of hikes, but, you know, no one has that as their base case.
Okay, it's time to listen into some expert views on the Federal Reserve's latest decision and their outlook on the Fed future rate moves.
Either one or two rate cuts would be appropriate, but basically that's only 25 basis points we're talking about. So that means it's the same monetary policy, steady as she goes. It means that close to the election, the Federal Reserve will probably sit tight. It's very, very rare that they would change just before November. And so the next rate cut may well be in December, right after the election.
I think the market will have been responding to better news in inflation this morning. But of course, the summary of economic projections, that was revised since March, not since the May meeting. So that's relative to what they thought 3 months ago. But still, I think it was reasonable to say that, of the officials in March, maybe on average they go up 25 basis points at the end of the year, not 50. So this would be a hawkish result in the summary of economic projections. And the problem is that if the Fed doesn't project a September rate cut on average, then it's much harder to implement one. So, we're of course we're just playing with small numbers here and decimal points. But overall, the market, which was reacting very well to this morning's CPI report, will be somewhat disappointed that the Federal Reserve now sees only one rate cut this year.
At the beginning of the year, where we were forecasting 6 or 7 rate cuts, and then we kept whittling them out, and we got down to now 1, and the S&P just keeps going up because I think they have confidence that the Fed is going to get to where they want to get to, which is ultimately their 2% inflation target. It may take a little longer, but the process of getting to an anchored inflation expectation outcome and the Fed doing what they set out to do it's in train. And I think that's what he told you today. He was very positive on today's inflation print. He was very positive on the progress that's been made. And he's just telling you it's going to take a little longer.
They've been tilted towards cuts ever since, I would say, November 1st, which started everything off in this rally. It was reinforced, I would say, at the last meeting, where it was quite a surprise to the market. There was a fear that there would be more talk about potential hikes, that it wasn't all skewed towards rate cuts. I think that the labor market is weakening. It's not weakening in a way that's alarming, but the unemployment rate has been going up. The household survey looks pretty bad. I mean, part-time jobs is negative. Full-time jobs, rather, is negative year-to-date on the household survey. And he tipped his hat to the fact that we have highly contradictory data. That's because we have a highly inconsistent economy. And I think that's a theme that's been developing in commentary across the board.
Okay, that's all about the Fed's rate decision, the commentary coming in, and expert opinion as well. It's time for a break now. When we come back, we'll tell you how all these global and domestic cues impact our own markets in our Power Prep segment. Stay tuned. Welcome back. You're still tuned into Power Breakfast. We spoke about the global market action and the Fed rate decision as well. But how will these overnight cues impact our own markets? We have our research team joining in to tell you what the trade setup is looking like, the stocks that are likely to be in the news, and the action from the F&O space as well. Very good morning to all of you guys. Harmas, let me come across to you first up. What is the market setup looking like today?
Morning, Sonal, and the setup is that of hope, and the hope is that the Nifty will eventually break out from the range that it has been stuck in over the last few trading sessions. You spoke about the Fed rate decision, you spoke about how the US markets reacted to it, the S&P 500 and the Nasdaq hitting record highs overnight. The GIFT Nifty is pointing to a gap up and is implying that the Nifty will start off around that 23,450 mark, which is the upper end of this 200 to 250 point range that the index has been stuck in over the last few sessions. 23,200 on the downside, 23,450 on the upside. We made a new record yesterday, which was 23,441 and reversed from there, but we managed to end in the positive, so that is a good there. The Nifty fell around 120 points from the highs. The Nifty Bank also continues to face resistance at 50,000, fell over 350 points from the day's high of its own as well. So there, the Fed commentary is one that the market will react to. The market will also react to the CPI IP data of our own that we reported last evening, mostly on the positive side as well. And of course, today being the Nifty weekly expiry, so we'll keep an eye out on those moves as well. But watch out for IT stocks in today's trading session. The Nifty IT saw a bit of profit booking on Monday, but has been extremely flat over the last two trading sessions. And considering how the Nasdaq behaved overnight, that is a sector that may be in focus. And also watch out for the broader markets, because the mid cap and the small cap indices have been up for 6 days in a row after last Tuesday's fall. So will it be interesting to see if the rally continues in the broader markets as well. But overall, the GIFT Nifty is pointing to a positive start for our own markets.
Okay, a positive start is what is expected today. Let me go across to Vamakshi. She will list out all the stocks that will be in focus today. Good morning.
Good morning, Sonal. Let me first start off with Dr. Reddy's. Its arm has signed a license agreement with US-based Ingenious Pharmaceuticals. The arm has gotten exclusive rights to commercialize cyclophosphamide injection RTD in the US. And in fact, under this agreement, arm Dr. Reddy's USA is expected to pay 50% of the calculated profit share. Sources on L&T Finance suggest a block deal is likely today. Bain Capital could likely sell 3.5% stake. This is expected to be a cleanup trade at a floor price of 169.17 per share, which is at a nearly 1% discount to current market price. Shobha, the board has approved rights issue of up to 2,000 crores at an issue price of 1,651 per share. Paytm also in focus. Paytm General Insurance request for withdrawal of application for registration as a general insurance company was accepted by IRDAI, and this is in line with the company's plan to focus away from the insurance manufacturing business and focus towards the insurance distribution business. Gensol Engineering has emerged as a successful bidder for a 250 megawatt battery energy storage system of Gujarat Urja Vikas Nigam. There is also a green shoe option of a similar size, and in case of exercise of this green shoe option as well, the project could potentially generate revenue of almost 2,680 crores. Arvind also on our radar. The strike at Gandhinagar based Santej plant has been called off by the workers. The company estimates potential revenue loss of around 180 to 200 crores and estimates reduction in EBITDA of around 60 to 65 crores. Prestige Estates, clarifying on its hospitality business IPO to CNBC, says that raising capital is a normal activity in real estate business. They are contemplating to raise funds for a few of the projects, including hospitality projects, and they are still in the process of deciding the future course of action. Saxoft also on our radar. They've signed a share purchase agreement to acquire 100% equity in Augmento Labs for up to 100 crores with upfront cash consideration of 35 crores. And lastly, let's also focus in on Nestle India. They will be continuing to pay royalty fee at current rates of 4.5% to its parent company.
Okay, all right. Those are some stocks on our radar today. Let me go across to Manglam. He's joining in with all the cues from the F&O space this morning. Good morning.
Good morning. So it's a perfect setup for a bit of a rally in today's trading session, and that's largely because, one, we've been in a bit of a range yesterday as well. Both the indices, the Nifty as well as the Nifty Bank, ended off highs. The Nifty Bank facing supply upwards of 50,000 and the Nifty itself upwards of 23,402. But ahead of the Fed meet outcome, most of the street was light, and that was reflected in the way we saw a sell-off in the IT index itself. The IT index actually ended at the low point of trade, as you can see, ahead of the Fed meet outcome. So the street had lightened its positions and there were no negative surprises that came in from the Fed. And usually the mid-cap and the small-cap indices rally when they see limited downside for the frontline indices, and that's exactly what continued. The GIFT Nifty, as a result of which, is indicating a strong start. Cash market flows, no real problems there, both DIIs and FIs purchase. But the Nifty June futures turned into a premium versus a discount, telling you that there was aggressive purchase in index futures. So nearly 3,000 crores worth purchased by the FIIs. They unwound about 21,000 shorts, 25,000 shorts, and added 21,000 longs. And as a result of which, the long exposure has increased to 41%, and the net exposure is now down to just 80,000 contracts. So that's a positive. Today's Thursday, Nifty weekly options expiry. We're seeing writing at the 23,400 call and the 23,500 call. At the same time, we're seeing writing at the 23,400 put for a premium of a little over 120 rupees, and 23,300 put as well. What does all of this mean? Option writers are expecting a trading range of 23,250 to 23,500. Does it break out of the range or not is something that we'll have to watch out for. A couple of stocks, a lot of long positions added on HDFC, AMC and LIC Housing Finance, which did well. And Z, as we pointed out, the open interest was falling below the market-wide position limit, and the stock, as a result of which, is out of F&O ban.
Okay, all right. Thank you so much for that, Mangalam. That's our Power Prep segment, and that is what is expected from our trading session today. Moving on now, CPI inflation eased to 4.75% in the month of May, while core inflation cooled to 3.1%. This even as food prices remain stubborn. Industrial output in April continues to remain steady with a 5% growth. Lata Venkatesh joins us now with the details. Lata, take us through the numbers.
That's right. This is a double delight for the Indian economy. The inflation number has come in a tad lower than expected at 4.75 versus 4.9 that our poll threw up. And the industrial output number for April has also come in at 5 compared to 4.7, which our poll threw up. So growth better than expected, inflation lower than expected. What more could we ask? Just a word more on the inflation number. The core inflation number has come in at 3.1, lower than the 3.2 for April. Actually, a year ago, the core inflation was at 5%, and that is not even the highest. Earlier in 2023, core inflation was even running at 6%. This is a steep decline, and at 3% or 3.1, we are a distance away from the Reserve Bank's, targeted, the MPC's goal of 4% for overall inflation. When core dips so much, and the Reserve Bank repeatedly says that it is core that they can target, they can't do much about food and fuel, then questions will be raised whether Reserve Bank will be propelled towards some kind of dovishness. Food inflation has come in at 8.7, but that's largely on expected lines. Chances are that food inflation will jump up a bit in the months to come. Although there is a base effect, there is usually the vegetable prices that go up in June. So food inflation will be watched. There is news that the MSP for sugar is being raised. It's possible that other MSPs will be raised because of the nature of the electoral verdict. So we have to keep our eye out on food inflation. Nevertheless, the overall inflation is definitely undershooting the Reserve Bank's forecast for April, May, June at 4.9. Chances are that it will come at probably 4.7 or thereabouts. On industrial output, there isn't much to say. At 5%, it's better than expected. Capital goods at 3.3 is a bit of a disappointment, but consumer durables at nearly 9% is good. Again, there is a base effect. So not much to speak about growth. It's a decent number, almost on expected lines, but inflation clearly a delight. But of course, all eyes are on what the global cues are.
Oh, yes, absolutely. Thank you so much, Lata, for all those details on the inflation print. Let's sip into a break. When we come back, we'll talk all about the commodities market, so stay tuned for that. Welcome back. You're watching Power Breakfast on CNBC-TV18. Let's talk about the impact of that big Fed rate decision on commodities. Manisha Gupta is joining us with all the update. Hi, Manisha. Good morning.
Morning, Sonal. As on expected lines, well, after the U.S. Fed has left interest rates unchanged for the 7th meeting and have projected only one rate cut in 2024, there is a bit of a profit-taking that we have seen across commodities. Starting with gold, and we were trading at 23.30 yesterday. It's holding about 23.10 right now, so some bit of a decline. But the interesting point is that 2300 is still holding because, remember, there are 4 rate cut projections for 2025, and that is what perhaps markets seem to be working upon. Also, the U.S. inflation data at 3.3 GDP for the month of May is lower than 3.4% of an expectation, and that also seems to be supportive. So while gold still may be trading firm, it is the silver prices which are now trading at a 4-week lows from almost $30 yesterday. We are trading at around 29, ready to break that too. Copper prices also have come under pressure. It's trading at a 1-month lows right now, and the crude oil prices also have seen some pressure coming in. Apart from the U.S. Fed meeting, it is about the U.S. inventories which have risen. The ongoing ceasefire talks in Gaza also seem to be weighing on. So just about holding $82 in the Asian markets right now.
Okay, all right. Thank you so much, Manisha, for joining us with all those details from the commodity market. So that's the market action now. Let's shift focus to Odisha. 52-year-old BJP MLA Mohan Majhi took oath as Chief Minister last evening. This comes days after the BJP secured an absolute majority in the Odisha Assembly elections and ended Naveen Patnaik's 24-year rule. Odisha will also have 2 deputy chief ministers. KV Singh Deo, 6-time MLA and member of an erstwhile royal family, would be one of Majhi's deputies. Pravati Parida, a first-time MLA, has also been chosen as deputy CM. Let's move on now. At least 40 Indians were killed and over 50 are injured after a fire broke out in a building housing workers in Kuwait City yesterday. The authorities have said that they have contained the fire and are investigating the cause behind it. The fire reportedly began at a kitchen before spreading through the building. The Ministry of External Affairs has said that they are ascertaining the full detail from the concerned Kuwaiti authorities. Prime Minister Narendra Modi announced ex gratia relief of 2 lakh rupees to the families of deceased Indian nationals from the PM Relief Fund. The Minister of State External Affairs KV Singh is also travelling to Kuwait today to oversee assistance to Indians injured in the fire tragedy and work towards the early repatriation of mortal remains.
The situation is that the victims are mostly burn victims, and some of the bodies have been charred beyond recognition. So a DNA test is underway to identify the victims, and the Air Force plane is on the ready, and as soon as the bodies are identified, their kin will be informed, and our Air Force plane will bring the bodies back. The latest figures that we had last night, the casualty figures are around 48, 49, out of which 42 or 43 are believed to be our countrymen Indians.
Okay, let's move on. The Indian government has said that 2 Indians who were recruited by the Russian army were killed during the ongoing conflict with Ukraine. Early in February and March, 2 Indians were killed when they were forced to fight in the conflict with the Russian army. They hail from Surat and Hyderabad. India has called for the early release of all Indian nationals who are with the Russian army. The External Affairs Ministry has also urged Russian authorities to stop recruiting Indian nationals in the Russian army.
रशियन ऑफिशियल्स को ये स्पष्ट रूप से कहा है कि भारतीयों की जो भी भारतीय युद्ध क्षेत्र में किस प्रकार से आए हैं, कैसे आए हैं, वो अलग बात है, उनकी वापसी की जाए.
Okay, all right. Those are all the updates, the national updates, so to say. But with that, we'll take your leave on this edition of Power Breakfast. Stay tuned. Bazaar Morning Call comes up next.